All right. I am here with Richard Wilson, and he is the CEO of Family Office Club. How's it going, Richard?
Good. How's it going, Steve?
It's going good. It's going good. So, before we get into some tactics and just basic overview of family offices, because a lot of people have asked me about this, and I've never really had anybody on the pod to discuss it. Before we get to that, let's talk about you. Let's talk about your background and how you really got into this.
Sure. So 18 years ago, I was raising capital for hedge funds and SMA products, and I was calling on wealth advisors, and some of them said, well, we don't have accredited investors, or only half of our clients are accredited. So I was like, well, this is a waste of time because I couldn't invest in this hedge fund. So then I called one group and they said, well, we're a family office, so all of our investors are accredited. And I said, oh, a family office, what's that? And they're like, oh, well, it's basically a wealth advisor for the really ultra wealthy, usually those with 10 million or more in capital. And that led me down this rabbit hole and led me to decide, okay, I should only call on family offices, forget all the other wealth advisors out there. Then I found out that there's multifamily offices that manage multiple clients, or you can create your own family office for yourself, called a single family office. And then started blogging on it. The blog took off and got 5,000, 7,000 hits a day. We bought familyoffices.com, and now 18 years later, I've written a dozen books. We've got a big YouTube channel and the most visited site in the space. And it's just been an educational journey, just sharing what I'm learning along the way and staying focused on that niche for 18 years.
Nice, very nice. I like that. And learning from a lot of the people that are coming in, I'm sure, as they're sharing their stories and everything. And I
Right.
guess, how did it come about to start a club? Because you got the site going, you're really generating a lot of momentum. How did it come about?
Yeah, good question. So we had the blog, and I looked at the top 500 keywords people searched for related to capital raising, family offices, hedge funds, etc. And I systematically wrote two blog posts and SEO'd it to rank well. I was an old SEO Moz, follower for old school pro blogger follower, etc. And that led to people asking for things, and it led to speaking engagements. So at age 26, I was speaking at events in Russia and Europe, etc. And basically, I realized a lot of the people hosting events for investors don't really know much about them. They're just a media company, an event company, and the investment niche is just one of their 20 niches. They also do a defense industry conference, and so I said, oh, we could host our own events. And as I started hosting more events, I realized having a community is more valuable than just a conference. So that just led to doing Family Office Club as a community instead of just doing one-off conferences, essentially.
Nice, nice. And I think that's been quite the trend over the last like 5 to 10 years is the community, like building communities
Right.
and just dense kind of groups of people
Yeah, and
all.
what's funny about that is people who are familiar with Flippa and this podcast, or familiar with like business valuation trends, know that like SaaS has been all the rage, right? Like, oh, subscription, you'll get 6x revenue instead of four times profits or whatever, right? And so someone might hear that and think, oh, it's just like SaaS. It's just, people are doing this for a ploy to just make more money. But in the investment world, it's so important to meet face to face, know who you're working with, get to know someone over time. If you plant seeds with $100 million net worth family, and then a year and a half or 3 years later, you ask if they want to buy your business or invest in your business, they're way more likely to say yes versus like, oh, hey, I'm Steve. You want to buy my business? And they're like, what? Who are you? Like, I don't trust anything you're saying right now. So let me put my guards up. And that's why the community is important, right? Like, no one wants to put 25K or 100K or over those amounts into things usually, unless they meet someone in person, especially not 5 or 10 million, right? So
Yeah. Yeah. Building over time. And so you had the credibility of the blog, really ranking highly. You build this club. And how quickly did it grow? Like you have $100 million families, family offices signing up. How quickly and what are the numbers around it that you were tracking?
sure. We pretty quickly got to the 1,000 hits a day to the website, and 3,000, 5,000 within our first year and a half to get to 5,000. But in terms of revenue, our third full year in business, we did seven figures in revenue. And then in terms of quality of families reaching out, I remember being excited when we had the free blog and we just had a few advertisers on it, when people would actually call me. And it was so weird to me that a $100 million family or a $500 million multifamily office would call me asking for advice on what they should pay their new CIO or CEO when they're the one running the family office. And I just started this blog on family offices last year as a 26-year-old kid. And I was like, whoa, they're asking me for advice? Like, I'm just trying to learn the industry here. And then the light bulb went off that a lot of these people are busy, only know 5, 10, 20 of their peers well enough to ask these types of questions. And when I positioned myself as having interviewed all these family offices and read everything on the industry and produced 500 articles on family offices, then people felt like, okay, well, you talk to other family offices more than I do. And so even though I am a family office, you might know more about my own industry than I do, is what like a light bulb went on in my brain. So that was kind of like the turning point where I realized it was just a unique position and a unique role to play in the industry, even if I didn't have their level of experience at that point.
Very cool. Just the wide net and talking to so many people really just built up the
Yeah.
credibility. Love that. So let's talk a little bit more about how listeners, like entrepreneurs that are building something, they're operating currently. What is it that attracts like a family office to that type of like a founder led business?
Right, right. Well, at the core, the thing is that most investors, almost all of them that we work with, are really just entrepreneurs that have done really well. Someone like yourself who's sold a business, or you've learned how to cash flow at 7, 8, 9 figures a year. So most investors are really just super founders. They're just like super entrepreneurs that have made it to the other side a couple of times, maybe. And now they want to back other entrepreneurs that probably will make it to the other side. And it's really as simple as that. And so being clear, being honest, being genuine, authentic, transparent, being the things that you would want a business partner to be for you, being high conviction, compelling, unique in 2 or 3 ways. So many people pitch things to investors, and it sounds like everyone else in their niche, right? And they offer them the same terms, say the same lines, and so definitely don't do that, and don't be long-winded. Many times if you're approaching an investor cold, you need to add value first. How can you help them? Like why, how can you make your email be the most valuable thing in their inbox for that day? And out of 400 emails, why is it in their best interest to reply to your email? Right? If you're not doing that and saying what you're doing in a sentence that blows people's minds, then you're just dead in the water and you're just not going to get anything back from people, I think.
I like that. Out of all the emails bubbling to the top, what can you do to get the hook? I like that. So
Right.
with the mistakes, I always like to hone in on just
Me
the
too.
potholes that people hit and just the mistakes that
Yeah.
you've seen front row. What are some of the ones that come top of mind?
Yeah, the biggest mistakes we see every single hour of the day is people think that by going around and saying, I've got the most amazing deal you've ever seen, or I've got like the highest return deal, or this deal is going to 10x your money. It's like that means absolutely nothing if they don't know you. They would much, much rather invest in someone they trust who they think really does add value in a clear way they can understand, even if that will only 2x their money, than some random Joe off of LinkedIn that says they're going to 10x their money. Like that doesn't matter at all. And the fact that you're going around promising 10x and leaving no room to overpromise means they don't even want to hear your pitch. They don't care who you are because you either are not experienced enough to know that there could be a lot of risks, or you're overpromising so much that there's no chance to truly over deliver. So that's the number one thing. The other thing is that when people rush around in a feeling of being stressed out or anxious or rushed, and they try to rush a really big investor, they'll just back off and go dark on you a little bit because they want to get to know you and make sure the context makes sense and that they can trust what you're saying. And ironically, in this space, the more you try to do things the quick way, the more it will slow you down. And the more that you do things the right way for the mid to long term, the faster things will go for you because people will see this is someone who acts like me. He plans medium, long term strategically. He's not in a desperate rush. He's not pressuring me and creating fake pressure, making things weird. They can sniff that out because these are like seasoned entrepreneurs, right? Like they can sniff out that, a mile away in the jungle and they will not engage with you.
I like that. So not too
Right.
pressure cooker kind of. I think
Right.
that's
Right.
good. That's good. So with some of the mistakes, now having gone through those, let's talk about prepared aspects. Like all the people out there that are listening that are in the trenches building their business. What are some of the things that you've seen really work to be prepared?
Right. Build your business in a way that, you really want to question yourself of if you do want to sell it or not, because the business does run pretty well without you. It is a growing, healthy business. Like, you can show your numbers and know your numbers, and the accounting can be trusted and is, relatively well organized, et cetera. So the more you prepare your business for a sale, the less you'll may want to actually sell the business, because that's what also makes it appealing to an investor. That's fairly obvious, and probably people have heard that before on this type of a podcast. But some things that I think people need to do to prepare when they're going out to talk to investors, everybody gets these things wrong. Like, I literally don't know if I've met a single person that has gotten all these things right. We talked about having your whole pitch narrowed down to a one-liner, but you also need to have a 1 to 3 minute video from your founder saying what it is you're raising capital for, what it is your company does, basically saying your one-liner and a few compelling things, or show your manufacturing floor, show your product at use, show your AI tool, whatever it is. Most people do not have a one-pager. They have a pitch deck that's way too long, and nobody will read your 44-page pitch deck. If you put the word Mickey Mouse on page 39 and ask your spouse and your business partner to review it for mistakes, they will not catch that on page 39. They'll say, yeah, it looks good. And they will not catch that. And so investors who are busy have less time if they're more valuable. If they're worth $100 million, they have 1,000 employees and more time pressure than your next door neighbor investor. And so what I'd recommend is to always have a 1 to 3 minute video from the founder, always have a single line sentence, always have a one pager which summarizes your pitch deck and is cliff notes, and never have your pitch deck more than 19 to 25 pages long. Most people get all those things backwards. They write an essay long email. They have a 44-page pitch deck. They have no one pager. They have no founder video. And their version of a one-liner is a fat paragraph and too long of something for someone to really get what you're trying to do or what you've done.
Yeah, the sort of over communicating rather than just building trust and getting their attention, I think is definitely a big disconnect that I've experienced. I know a lot of people have just leaned in a little too heavily up front when you got to take your time, got to slow it down.
Right. Or like in the copywriting world, they say, I'm sorry I wrote so much. I didn't take enough time to make it concise. So some people might see it as over communicating, but I see it as you could communicate even more with only 20% of the words if you were super thoughtful and you dialed it in, and that was version 30 of your one liner. So a lot of it's just sloppy communication, versus, in my mind, over communicating, because you want to communicate all those killer points, but do so in a very concise, organized, visual fashion, not a 2-page letter that no one's going to read.
Yeah. So let's shift gears a little bit to
Sure.
like the kind of negotiation aspect of things. When it comes down to it, and let's use the context of exiting, what are kind of ways that you can approach valuation? Because we've talked about how to present, how to get people's attention, but when it comes to the actual negotiation, I think that that's a part that a lot of people don't really understand.
Right, right. Yeah, I think there's a big difference if you're raising capital to grow versus looking to sell.
Mhm.
I think it's fairly obvious the more buyers you have at the table, then the better it's going to be for you when you go to sell. So I would start the negotiation early and bring many parties to the table. I would think, who would be the partner who would give you massive distribution? It would be your dream partner for your business. They may be the best person to buy your business, because they will also see that what de-risks the whole deal is that they can jack your revenue up dramatically and maybe reduce your costs at the same time and force appreciation of the asset, versus just some high net worth investor who wants some passive income, right? And so you can always sell to someone like that, but I would create a lead list of 30 people who would be your dream partners, maybe work that list as partners, and you might develop a buyer list at the exact same time. So the best negotiation is really when the other party is very hungry and there's other hungry, excited parties at the table, and you've de-risked the transaction. If you're raising capital, you want to find ways to structure the deal so the investors get their principal capital off the table, and then they sleep at night knowing the rest is gravy and upside. And I think that the structure of the deal matters so much. Like, in this industry, so many people brag like, "Oh yeah, I got 7 times profits." It's like, okay, well, if that was from a private equity firm, they probably gave you rollover equity. You probably have an earnout. They probably have delayed payments on some of it. And they actually paid you very little up front with all these promises dangled in front of you in a 140-page agreement. And some of that money will never see the light of day. And now you have handcuffs and you have a job for 5 years. It may have been better for you to get 4 times profits, be free and clear 12 months from today, and then just be on a light consulting basis for another year. And you can go off and do your own thing under less of a non-compete in a 44-page agreement. And so I think you have to be super careful in how you structure it when you're selling the business, but also when you're raising capital, or if you're an investor listening to this, you can take an average deal and make it amazing with the right structure using, we've done probably 15 to 17 deals now using gross revenue royalties to de-risk a deal and structure a deal. And so a structure can kill a deal or make it amazing, or just sit there on the shelf and do nothing for you, and then you're really losing by not, navigating how to make that structure sweat for you.
Nice. Yeah. Let's double click on that. I'm really curious about the creative deal structures. It's like
Yeah.
part of the whole fun of this is like
Oh yeah.
the real creativity that a lot of people don't
Yeah.
understand behind the scenes goes into
Yeah.
these. And I'm just curious to get your take on some of the most creative ones that you've seen.
For sure. For sure. We could do a whole episode just on this and I would nerd out on it and it would be fun. So let me give you like some really tangible examples. So we acquired more single name medical domain names than anyone in the industry, like dermatologist.com, obstetricians.com, birthingcenters.com, et cetera. We got like 23 of them. I put a bunch of my money into that deal, and I thought to myself, who else would back me on this idea? It's kind of a weird idea, right? And I just, the search volumes for all these terms are going up. I think digital assets are going up, and so I reached out to my one friend who's a centimillionaire. He said yes and funded the whole deal upon one 10-minute phone call, and we got the deal done. And how do we do that? I basically told him, like, hey, I put my money into this deal. I want you to put this much money into the deal next. As we monetize these assets, you get all your money out first, then I get my money out, and then we're pro rata partners going forward after that, because the upside, was big on this deal, and I wanted a third party, to fund the vision on that. And the reason why he said yes is that if we only make a partial sale of these assets, I take 100% haircut, and I'm bald, and he doesn't take any haircut because it's my fault if the idea didn't work out. It's not his fault, and so he's protected by my sunk investment in the deal. On another deal in a dental practice, we invested money and we got a gross revenue royalty that gave us a return up to X. And then we did not get any more return after we hit that threshold. And another deal in a manufacturing company, as the last example I'll give just to make it clear, we basically got a gross revenue royalty until we got 1.4 times our money back. Our equity warrant that could not be diluted at the exit went from 18% to 16% at that point, and the royalty went down to a little drip for being on their advisory board, basically. But now we get 16% of the business when we sell, and we get a little advisory board drip. So there's some creative structures where you either have multiple share classes or LLC membership types and royalties that change based on de-risking the deal, et cetera.
Very cool. And for everybody listening, I think there's a special breed of people that get very excited about these types of of deal structures. I've always loved the creativity and thought that goes into some of these structures, and I like I haven't even heard of the gross revenue royalty dropping to zero after a certain period of time. But then there's even like the warrant piece is really clever. So there's so many tools out there to structure a really
Yeah.
creative deal. And I'm a firm believer in just make it as creative and fun as possible, because otherwise the process is is going to be,
Painful.
yeah, super painful unless you're working on some creative aspects.
Yeah.
So
And the other thing
I
I've learned the hard way, though, is that like a lot of investors just breathe a sigh of relief once the money's back in their pocket. And so, being really lean until an investor has broke even, and then you can charge more healthy fees. And then maybe at some point they've done so well, they're cool being your 50-50 partner in a deal. I just think a lot of investors think that way and think that that is fair, right? At the beginning, you got to get their money back in their pockets so they can recycle that money into another deal. and then everybody wins at the same time, or the investor wins first and then everybody wins together. So I think that's like a theme to a lot of the creative structures.
Hmm.
Even if you're saying to somebody like, hey, we're going to triple your money, but then you're out of the deal, you're not getting more than a 3x return because we're doing all the work, but we're going to be super lean on our fees charged to you until you double or triple your money, but then you're out, you're capped. And so just balancing that equation is definitely a fun thing. And I think it's a learning process. And so many investors and capital raisers ignore structures. They just go to the lawyer and be like, what structure should I do? And they say, well, everybody does this robotic structure. And I'm sure that saves a lawyer a ton of time. So they just use a template and charge you $40,000 for a template or whatever it is, $10,000 for a template. But is the template really the best way? The way that everyone does things is never the best way, ever. Like we interviewed 45 billionaires for my website, billionaires.com, where we're interviewing 100 billionaires. And I've read 120 books authored by billionaires, and we've hosted 300 investor club events. Everybody who's ultra wealthy does things that most people don't do. That's the
Hmm.
whole point of a podcast, right? It's like, what new things should I be doing?
Yeah, yeah, that's right. It's always kind of on the fringes, on the alternative ways that you don't
Yeah,
really expect, which is always
exactly.
the fun aspect of trying to find something like that that'll work. So let's talk about the timing. This is always the most common question. That's a perfect segue here because we were just talking about, when the investor gets their money back into their pocket, they're a little less worried about it. But for the operator out there,
Sure.
when is the right time to exit?
Sure. I think there's been a few people, like one of my clients, he started with 0 mobile phone centers and he developed 130 of them. But he saw the writing on the wall that the distribution agreements between the big cell phone carriers and how they treated their retail outlets was shifting and it was
Hmm.
starting to get worse. And he was one of the biggest, he was the biggest retail owner for this mobile phone carrier. And so he could see the writing on the walls at the board meetings of like, margins are coming down and some people are going to get squeezed here over the next 4 to 7 years. And he's like, okay, I think we're out. We got to critical mass. We're getting offers all the time. I mean, once you have more than 10 or 20 retail centers of anything, you get offers every day or every week, right? So for him, he made a great exit because of that. For one of my billionaire clients, we've closed 19 transactions for them that we sourced and helped negotiate and structure. And twice now, he's timed the broader market within 6 to 9 months of a major drawdown. And it's a big part of why he's a billionaire. And so I think some of being a successful entrepreneur, like you haven't gone through, I think 3 exits now, you said before we started here. So part of it is learning to trust your gut and ignoring the people on your team, even in your family or in your industry. And you have to trust your gut because you have thought about your business and your demographic and your competitor set and what's going on around you in your sandbox more than anyone else on planet Earth. Like your business and that environment. So you have to be careful not to make a rash decision out of fear, of course, but like you have to trust your own gut and just move with conviction when you think it's the right time to pull the trigger.
Well said. So that leads us to the finale. Knowing what you know now, what would you tell Richard 10 years ago?
Buy some Nvidia stock, a lot of it. I'm just joking. What did I tell myself 10 years ago? I think that going really deep and being world class and having that mindset of going really deep on a niche is something people don't want to do for 10 and 20 years at a time, right? People get distracted, they want to chase, crypto, chase sports betting, chase cannabis, chase AI. I think that our success has been from that focus. And I think that along the way, we've tried different ways of monetizing our investor club, but now things are going better now when we're focused on, for example, if we do something quote unquote new, it's buying billionaires.com, interviewing a whole bunch of billionaires, reviewing, basically releasing that content for free, but having the billionaires on stage at our events, and it just makes our core stronger. Or if we're going to get distracted, quote unquote, by a shining object of AI, it's because we built out an AI due diligence tool for investors or an AI tool to help people raise capital. We have 10 of those out there now, but it's not a separate product that's distracting us. It's core. And so I think staying focused over a decade or two and being more focused. I think in the past, sometimes the way we tried to monetize our investor club was partnering with an outside firm or, using capital here to do something in a completely different niche. And like most of it kind of worked, but it wasn't as electrifying as really being laser focused on your core sandbox. And any new shiny object needs to be a mini funnel within your core funnel. I think that's like something that it's just been beaten over my head several times now. So it just the lesson of what Peter Thiel says, extreme focus is a superpower, I think is a more simple way of saying that rambling answer, basically.
Nice. Nice. No, that makes perfect sense. The focus is very, very valuable, especially nowadays with just bottomless amounts of information coming at
For
you
sure, for
all the
sure.
time from all directions. So
Yeah,
we were talking before we started recording about a couple tools that you built out. Let's talk a little bit about that. I'm curious how
awesome.
how those work and where people can learn about them.
Yeah, super nerd out on this stuff. So the tools we've created are three different types. The first type is really collective intelligence tools. So what we found is there's 986 talks publicly given by billionaires. I took the time to have my team transcribe all those 986 public talks and put and trained an AI tool based on the insights of these several hundred billionaires. And then I interviewed 45 billionaires and put that in there along with the fireside chats we've done on stage at our family office club events, et cetera. And now we have this billionaire collective intelligence AI brain because if you ask questions to GPT or Grok, it's getting answered by the collective wisdom of Wikipedia, random things that scanned online, and then 300 million users that put stuff in there that's not always right. And so the infograph instead now, that AI brain is trained on billionaire wisdom, not random wisdom from the internet plus random users, right? And so the answers you get are completely different. And it quotes the actual billionaires that the answers come from, importantly. The other tool that's a collective wisdom tool is our investor advantage tool. If you want to structure a deal smarter, scale something up, practice your pitch, etc., then we have trained this tool called Investor Advantage so that 1,500 investors who have spoken on stage at our events is trained in this AI tool. And you can hit record and act like you're in a meeting with a family office, and it will ask you questions that a sharp, candid, direct investor who doesn't care about being borderline rude may ask you when you're
Cool.
preparing to go sell, right? Or restructure your deal with gross revenue royalties or preferred equity structure, et cetera. Those are collective wisdom tools based on data we've put together. We have investor data tools, and those are like our investor pipeline builder and our investor club navigator. These are basically like we have data profiles on 22,000 investors, but who should you raise capital from or go to? Well, probably investors that are in your backyard or that you already know or have met at our events, investors that are near the assets you're acquiring. If you're buying dry cleaners all around Seattle, probably go to investors in Seattle, or people that are focused on your industry, maybe a healthcare angel investor club, if you're raising capital for a med tech company, obviously, right? So the people need to be local to you, the assets you're buying, or local to the industry. Like they already get the industry. You don't have to teach them, why you'd want to buy coin-operated laundry machines or whatever. And so those tools, essentially, you just upload your pitch deck, say where you're based, and then it will say, out of 22,000 investors, here's the 2% of them that you should care about. These are right in your backyard. They invest in your industry. They're more likely to say yes, more likely to open your emails. Forget the other 21,500. Just focus on these 500 based on exactly who you are. To do that manually and look through 22,000 profiles or even sort, filter on Excel would just be super painful. So that's the second class. And then the third one I'll describe real quick because this is the longest answer ever to a podcast question. But essentially, the third type of tool is we have about half a dozen tools that take your pitch deck and analyze it and criticize and help you improve it in 25 ways. Or take your pitch deck and it helps write 7 versions of a one-liner that's super credible and summarizes your whole 40-page pitch deck in a sentence in 7 different ways. Or helps you with some sort of positioning, marketing. For example, take the last email you pitched an investor with, put it in the tool, and it will grade your email and analyze it in 20 ways and say, it should probably be more concise. Consider this, and here's an example of what maybe the email should say. And importantly, anybody can do that with any AI tool, but it's going to be based off of random Wikipedia knowledge and random 300 million people using it, not 1,500 investors on stage. and our workshops on how to, reach investors and close them. So, we did a 80-minute webinar on it for free. You can stream that to learn about all 10 tools. It's on our YouTube channel called Millionaire Strategies. Just look for our artificial intelligence webinar, and we go through this in detail on our LinkedIn newsletter called Investor Club Edge. So you can see exactly what we're talking about. And I want to add one thing to that, but then I stop talking for a second in case there's a question or something confusing in there.
No, that was all good. I was just going to ask where people can learn more, but you were already kind of sharing the where people
Marketer
can
at
find
heart, I
it.
guess. So sorry. Hopefully, it's not like too like promotional, but they're not for sale separately. It's just part of our investor club, and it's not like a side product we're trying to monetize. But the most important thing I think for every investor and CEO to hear, even if you don't care about any of those things we just talked about, is that the three phases I think CEOs have to go through right now is one, using LLMs like ChatGPT and Grok. And then from there, finding vertical tools in your industry. You'll find most are broken, half do it, they promise. A lot of them don't work, and a lot of them are not built exactly for you, is my experience after trying 150 of them. And that's how we got to stage 3 on building our own tools for our own company and for our own investor club. And I think every CEO needs to get there to learn how to build at least one tool just for you. And we started with one called Dewey, which is just an instant due diligence advisor. And our investors are eating that up. So you can just send a pitch deck to it. It will analyze it, identify red flags, tell you what questions to ask. And if you don't get to that phase 3, then you don't know why everyone is so crazed about AI. You just think like, I don't know what all this fuss is about. It's like most of these tools don't work. This isn't built for us. It's like, yeah, it's not. And most of the tools don't work. So you got to build your own that do work.
Well said. Well said. Well, those are all the questions I have for you. Wherever you guys are listening on iTunes or Spotify, the links that Richard mentioned will be in the show notes. But thanks again so much for coming on, sharing your story.
Yeah, of course, Steve. And if you ever want to come to one of our events, I mean, you've gone through several exits, so we'd be happy to have you on a discussion panel or just have you as a guest at one of our Investor Club events as a thank you. We appreciate you having me on here, and thank you for your time.